Hey everyone, Dalton Grados of Grados Capital here, and I wanted to make a quick introductory video to credit spreads because if you've been following me or following this channel, you know that I have done a lot of different trading strategies over the past year or so, and what I really like to do now is I like to sell credit spreads and iron condors and some more complex option strategies because these strategies, although they seem complex at first, are actually worth learning because they are putting the odds and probabilities overwhelmingly in your favor. So I like to say it's like being the casino rather than the gambler. I'm only taking trades that I know are in my favor, and I have the statistics and probabilities to prove that. Or it's very much like an insurance company where I am not buying the calls and puts, I'm selling them and collecting a premium, and my goal for those is to expire out of the money, and the probabilities are in the favor that they will expire out of the money. So like an insurance company, I'm collecting premium every time I make money unless there's a tragedy. So I wanted to take a step back to sort of explain credit spreads and what they are and how they work for people that want to get into them. So I'd like to bring your attention here to this little chart, which basically explains options. Okay, so when you buy a call here, you follow this, you're on this side here, you're expecting the price of the option to rise. And you have a lot of things working against you too. You have theta that's eating up your contract's getting less valuable over time. You have IV, if the implied volatility dies, the premium of that contract will die. So when you buy a call, you really need the price of that underlying stock to rise in order for you to make money. Of course, if you are bearish on a stock, you can buy a put and you're expecting that price to fall, and it's in the same position there, just expecting it to fall. Now, if I am bullish on a stock, but I don't want to buy a call, I can also sell a put, all right? And my goal there is the price is expected to stay the same or rise. Because if I'm selling a put, I'm collecting the premium on it, and if it stays the same, then I expire out of the money and I collect all of that premium. Or if it rises, then that's even better for me because it's further out of the money and again expires worthless and I collect all of that. Same thing if you're bearish, you can sell a call rather than buying a put, and it's the same thing. The price can stay the same or fall. It just can't go below your strike price, and you make money. Okay, so I'm opening Tastyworks up here, and let's say I am bullish on SPX, this is the S&P index, and I want to have I want to sell a put for this Friday, the 29th. All right. So basically, what I'm saying here is that say I want to sell this one, the 3780 put. All right. So I'm going to sell that put, and basically what I'm telling myself is that I don't care what SPX does, as long as by January 29th, that expiration, when this option expires, that it is not at or below 3780. So you can already see, if you're thinking about this correctly, that there's more scenarios that allow me to win, right? Because the underlying stock, in this case SPX, it can go up, it can stay the same, it can even go down a bit from where it's currently at. So it's currently at 38.55. It can even go down quite a good bit. As long as it doesn't go below this 37.80, then I'm going to collect, looks like here, $880 of premium. Well, that's great, but look at this over here. The max loss looks like 377 grand. That's not good. And the buying power effect, because my broker is allowing me to use margin, is 88 grand. So not many people have all of that buying power to sell what this would be called a naked put. It's naked because you're just selling the put, and you need to have the buying power in order to buy back in case it goes against you, because it represents 100 shares of whatever you're selling. So if I'm moving too fast for you, that doesn't make sense, go ahead and rewind that and rewatch that back. Basically, selling naked puts requires a lot of buying power. and so most people cannot sell naked options. So what we do is we buy, in this case if we're selling a put, so we're bullish, then we buy the put a couple strikes underneath it. You can buy it, the strike directly underneath it, or you can play with the widths here. So let's just say we do a 10 wide credit spread here. So I'm selling this put and I'm buying the put below it, and now my profit is going to be the difference between the premiums of these two puts, right? Hopefully that makes sense, because the one I'm selling is more expensive, more premium. The one I'm buying is less premium, but because I'm buying that, it's representing 100 shares, right? So whenever I sell an option, that represents 100 shares. If I don't have the capital, the buying power required to put as collateral for 100 shares, then I just buy the put underneath it, and that option represents 100 shares. So hopefully that makes sense. But this one's more expensive, this one's cheaper, so my profit is the difference in the premiums between the one that I'm selling and the one that I'm buying. And look at what that does to my max loss and my buying power required. All of a sudden now that's affordable. Okay? Now, so I put up a collateral of $885 of buying power. My max profit is $115. And what I like over here is this section, which is my probability of profit, is 82%. So there's an 82% chance, based on where it's at right now, that this trade is fully profitable. Those are pretty good odds. You could go further out, you can get upwards of 90%. If I go further out, I sell the let's see, what if I sold the 37.45 and I bought the 37.35? 91% probability of profit. Now that's based on a number of things. That's based on, if we go to the curve here, our standard deviations. So if you remember in school, if you learn statistics or standard deviations, this is my trade setup here. I have this curve, and there's a 70% chance or 68% chance that the underlying stock stays between one standard deviation, and there's like upwards of 90%, I think it's like 95% chance that it stays within two standard deviations, just because prices don't move that dramatically, usually outside of those ranges, if that makes sense. So the further out your expirations are, the wider those deviations are going to be, because obviously you're giving it more time, and then the shorter you are, the closer you are to expiration, the shorter those deviations are going to be. So that's where this probabilities go and work in our favor. So let's just run through an example real quick so you can better comprehend this. So let's say I'm on Apple. Okay, that's not Apple. Okay, let's say I'm on the Apple stock and want to go to January 29th. That's this week. Okay, first of all, let's look at the chart for Apple. Okay, so we're on a 15-minute chart. Looks like it's in a, let's just say we're bullish on this, okay? So the price, so if we're bullish, we're going to sell a put credit spread, all right? We're selling puts and we're making a credit spread if we're bullish. So let's say this is my delta here. Usually if I say I wanted to go with this blue line here, that is the standard deviation. So we have our standard deviations here. We have the brown area, which is the expected move based on the current volatility and price action. And this is with Tastyworks. They illustrate this because Tastyworks, I use them. I'm not endorsed by them or endorsing them necessarily, but I do think that they're the best for this particular method of trading because they set up these tools. So this brown area here is our expected move. Let's say I just want to go right outside of it. I'm going to sell this put and buy the one below it. Okay, so for every $81 I have as collateral, I can make $19 of profit, and I have a 79% probability of profit. So I can buy a bunch of these. Say I have $1,000. okay, $1,053, make $250 by the end of the week. Now, what happens if this trade starts to go against us and it starts to look like it might not expire out of the money, it might actually expire in the money? Well, I can, of course, cut the trade for a loss using a stop loss. I can do what I don't recommend, which is letting it go to max loss. That is the amount of collateral that you put up for the trade, and that can be quite significant because the amount of collateral required for the trade is much more than max profit because your broker is making you put up more collateral because these trades, the probabilities are in your favor. So I don't recommend going to max loss. I do recommend using a stop loss if the trade starts to go against you, or if you still have the same sentiment on the trade. In other words, you are still bullish on the trade, but just at the current moment it's going against you, maybe it's getting close to expiration, you can roll the credit spread into a new expiration and oftentimes actually collect more credit than you initially collected. And I have another video on that, and I'll link it here in the video. I'll put a pop-up here and I'll link it down below. So in summary, credit spreads are a great way to trade more reliably if you're tired of losing, or like I was in the past, I was winning and losing and winning and losing, kind of just being stagnant in my trading. This is a way to get more consistent in winning, is by selling credit spreads. Again, because it's essentially like you're selling the naked options just in the form of a spread, in that the price can stay the same, it can rise. If your spread is already out of the money, then it can even go against you a good bit. As long as it doesn't cross that short strike, the strike price that you're selling, then you'll be good and you'll make the full amount of credit. So I hope you enjoyed this video. If you did, please give a thumbs up down below, comment, and subscribe to the channel for more videos, market content, and trading ideas. Thanks for watching.